Today, the Federal Open Market Committee decided to take another step in reducing the degree of policy restraint by lowering our policy interest rate by a 1/4 percentage point.
The Fed cuts rates but signals there'll be just 2 more rate cuts in 2025. Here to discuss is Michael Landsberg of Landsberg Bennett Private Wealth Management, and I'm Lisa Bernhard with Reuters. Michael, as I mentioned, investors were expecting the 1/4 point rate cut that we got today. But what about the fact that the Fed signaled just 2 more rate cuts in 2025? What do you think?
I think the Fed's trying to tell you that we're in an environment, I think, growth's pretty good. I think inflation is going to be higher than expected. And I think they're trying to signal to the market that, things are an environment where they don't want to continue to stoke these kind of animal spirits, if you will, by lowering rates and really adding more risk to the market.
Were you surprised at all? What do you think of the decision?
I'm not. I mean, I typically think the Fed has gotten, I looked last year, a year ago, we sat here and the Fed was talking 6 or 7 rate cuts in 2024, and this was the 3rd one. So I think 4 to 2 makes sense. I'm at 0 for next year. I don't necessarily think they're going to do that. I think inflation is going to continue to go up. I don't think it's going to go up to 9% or anything, but it's going in the opposite direction of what the Fed wants it to do. And I think that's an environment where you're not going to cut into that. And I think they've kind of pigeonholed themselves now where they certainly can't be raising. And you did see somebody today on the Fed and the FOMC go the other way. They didn't want to lower rates. So I think you're going to start to see more and more folks there that say, you know what, we're in an environment, we need to sit tight, let this play out, and try not to be involved too much in the market.
So we have an incoming president, obviously, in Donald Trump. And from what's been reported out there, it doesn't seem like he and Jerome Powell are maybe the best of friends. And also Trump has indicated that he would like interest rates to come down. So how does this whole scenario then play out when the Fed is signaling only 2 cuts for 2025?
I think this is a good point. I think what's going to happen, I think what Powell's trying to do in December, not wait into January, is to go from 4 to 2, indications of cuts. I think he's telling the marketplace, I'm my own person. The FOMC is an independent organization. We're not going to kind of listen to some of the pressures that are going to come. And I think it's smart on his part to get ahead of it. I do think he's going to face some pressure. If we're correct that inflation continues to go higher over the next quarter, and he's wrong for, not to the extent that he was in 2021 with inflation, but you do have some people around Trump that don't like the role of the Fed and the power that the Fed has. And I think he could get some people whispering in his ear about the power that the Fed has. So I think it's smart on Powell's behalf to get out a little bit ahead of this to try to get rid of some of the undue influence that may come out of it, or certainly the political back and forth that's going to happen, because Trump has been known to talk a lot more about Fed policy than any president we've had in the past. So it wouldn't surprise me if he does it again, especially if Powell's on the wrong side of inflation.
What do you think that these higher rates mean for earnings and for markets going forward?
I think what's happened is I think companies that have good earnings are going to continue. And we saw 8% year over year S&P 500 earnings growth. NASDAQ was up over 20. I don't think that changes the scenario where really strong companies are still going to earn money. I think what happens when rates start to not go down as much, some of the places that are really encumbered by higher rates, for example, small cap, it gets a little less attractive. And that's an area we haven't really liked for a while. It's flat for the last 3 years. I think small cap needed and still needs rates to go lower to get some of their balance sheets in shape. But I think the good companies are still good. There's a lot of themes that are still going to work at rates being where they are. I mean, AI is still going to work. Cybersecurity is still going to work. But I think some of these other areas that needed some balance sheet help, they're probably not going to get as much as they thought. And that may take the kind of the luster off of some of those names, specifically in the small cap and weaker balance sheet names.
With rates staying relatively high, what's your best advice to consumers out there?
I think you got to stay the course in terms of risk. At the end of the day, risk management is most important. So if you've had a great year in stocks as we have, you want to rebalance and take some of that from the winners and reallocate that to some of the stuff that has underperformed a bit. Still think you could add some to bonds. Bonds are not sexy, but you know what? They're not going to go down. I still think there's a good argument for, other assets like gold, which we've done well in. We'll trim a little bit there, but the US dollar is in a good spot. So I think you don't want to chase here. I think if you're a long-term investor, take opportunities. There's going to be volatility, specifically in tech. Take those opportunities. After the first of the year, I can imagine there's going to be a lot of selling simply because people have made so much money and don't want to pay the taxes. So use that to your advantage if you're underweight tech to do that, to add to some of those good names that you want to hold longer term.